This is your host, Caitlin Cook, and welcome back to the Dead Kate Bounce experience. This week's guest is Thomas Braziel. Tom is founder and CIO of 507 Capital, a firm that provides capital in insolvencies and bankruptcies globally. Mt. Gox, Voyager, Celsius, Three Arrows Capital, TerraLuna, the list goes on. Since crypto's inception, these are some of the most highly publicized scandals in and around the crypto space. But what actually happened? Where did things go wrong? Most importantly, what were the results and how do we learn from these scenarios? Historically speaking, many leaders across the space have shied away from talking about these things. If we bring up these stories, will they scare newcomers away? Do we cross our fingers and hope that everyone will simply forget as the ecosystem continues to grow? Thoughts like this have led many to sweep these situations under the rug until the next inevitable headline comes. As for me, I want to take a different approach. Why? Because if we don't address these topics, nothing changes. Nobody learns. It looks shady on the part of leaders and educators in the space, and certainly doesn't instill confidence in those on the outside. In fact, these are some of the main instances that people point to as a reason for why they won't delve into the space. So in this episode, we're going to talk about it. With that, please enjoy my conversation with Tom. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of the hosts or any of their affiliates. This podcast is for commercial and informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities or cryptocurrencies, nor is this an offer or sale of a security or cryptocurrency. All right, Tom, welcome to the podcast. Thanks for coming on.
Thanks for having me on.
Of course. I'm super excited about this one. We'll call it the FUD Buster episode. It's perfect, right? So there's lots of FUD out there, fear, uncertainty, doubt for the people who don't know the acronyms here. But with blockchain, crypto, whatever you want to call it, it's an upcoming space, nascent tech, emerging industry. People are experimenting. We've clearly seen that. Things will fail. We've seen things fall apart. But if we don't talk about these things, if we don't learn from them, what's the point? I feel like we'll just keep seeing this cycle of things repeating themselves. So want to get into it, want to talk about the things that a lot of people just honestly are afraid to talk about and bring up again because they don't want people to hear about it and associate the space with it. I'm thinking about the Mt. Gox of the world, the Voyagers of the world, the Three Arrows Capital, lots of ways we could go with it. But you sort of fell ass backwards into crypto. So I want to talk a little bit about, how you got in and, your sort of origin story, because I think it's super interesting and a really cool perspective for what we're going to talk about.
Sure. Thanks for having me on again. Very kind of you. And I totally love the fact that you're bridging the call it, FUD busters. I mean, it's impossible for an industry to grow and not have, hiccups along the way. And, so, I mean, it's something that always needs to be talked about. And I think if crypto is going to be mainstream, especially. So in crypto, there's lots of counterparty risk. I think you and I were talking just before we went on. It's like the financial system is being built in real time here, or, reimagined in real time. And so there's a huge opportunity, but there's also a lot of risk. And mainly it has to do not necessarily with the protocols themselves so much as, we'll leave Luna aside, TerraLuna aside, but the institutions that help you on and off ramps onto these things. And, self-custody is a real thing, or whatever call it. Unbanking yourself is like a serious commitment. I mean, for me, I fell into it through Mt. Gox. My background is my parents were lawyers. My mom was a bankruptcy lawyer. I used to hang out at the bankruptcy court growing up. And when I first came across Mt. Gox, I thought it was kind of interesting. And then as I bought a few claims, I was like, I really don't know what crypto is. I mean, I have the basic idea, like, okay, non-governmental money, that's kind of cool. But I hadn't really done the deep dive on, reading the white, just like philosophically understanding, like on how deep you can go with Bitcoin, which is kind of like I won't use a curse word, I don't want to be demonetized, but it's quite a head scratch. You're kind of like, whoa, is this real? I mean, if this is real, this is pretty deep and philosophical. So you go down the rabbit hole, you learn more. And then for myself, now I guess I'm so into it that I like to add my unique skill set to the industry and try to help out, because I'm a big believer in, you have to kind of make the future you want. And I think for this ecosystem, talking about FUD busting is super important. So you can't just be a constant cheerleader. I mean, there's issues that need to be dealt with, regulatory issues, legal issues, and I think some people's early adopters in crypto, especially if you were just a Bitcoin maxi, you were probably just like, hey, this is not really what it's supposed to be. Like, I don't like regulation. I don't like CFI institutions, stuff like that. I don't have a problem with it because it helps it go mainstream. But then we got to have some rules of the road. And we've got to also fight for reasonable and good regulation and for even protection for asset owners. That's one of the things that's come up in Voyager and Celsius, which is the current, flavor of the month in terms of restructuring. They're big and public. There are a lot of private things going on. We're just deleveraging situations where companies will do restructurings. But and so that's me. That's how I fell into crypto. And yeah.
Love it. It's just so interesting. Everyone always has such a different story with it, but I do want to ask, I mean, why distressed assets to begin with? Like, what brought you to that space? What was the appeal? And then of course, with crypto, we've seen ample opportunity to capitalize on that from a business standpoint too, which if you want to cover that as well, I'm all ears.
Yeah, sure. So, I mean, I used to run a tiny hedge fund. It wasn't super successful just as a business because we just had a hard time scaling. I was way too young starting a fund. And, people were like, hey, a lot about this distressed bankruptcy stuff. Like, you should focus on that. No one's really doing that for us. So it was clients that were pushing me that way, just listening to feedback of what they thought was a unique proposition that we could offer to them. And then from there, the crypto was like, hey, well, no one's really knows about crypto. Like, I remember the first time I was talking about Mt. Gox claims to someone. I've told the story before, but I don't know if you've heard it. But I met with a pretty well-known hedge fund, and the guy literally like slapped his leg and laughed and was like, "Oh my God, you want me to buy Bitcoin?" And I was like, "No, I'm talking about buying claims in this bankruptcy, and we're buying very cheaply, and it could be the future." And he was just like, I think the next 2 or 3 times I called him, he was like, Bitcoin. And I was just like, yeah, okay. Good to chat. So it was quite dismissive at first. So I thought like, hey, this is something where I could spend some time and have a little bit of like, what's the phrase in like football, like open field, like, sort of open field. So it was opportunistic on my part. And as I got into crypto, I was like, wow, like, I don't believe in all the stuff going on. And I guess I'm naturally a skeptical person. So I don't believe a lot of the projects will work. But there's so much good stuff in here for the future of the world and humanity. Am I allowed to use words like that? So I'm a believer. I'm totally sucked in. But of course, there's a lot of froth and silliness that goes on and shenanigans. And I wasn't sure the second part of the question, but that's how I kind of like decided to, I wouldn't say I only focus on it, but spend a ton of time on it. Is I figured there will be more cycles. There will be guys that get into trouble. And, there has been a fair share. You had Mt. Gox, Decornica, Cryptopia, Quadriga, Gigawatt, Factum. I can't think of some other ones. I mean, you had Bitfinance, you had hacks where people did recovery tokens. Those were kind of interesting. You've got news stories now today, like companies that are getting their lines pulled from their lenders, and the crypto ecosystem, all the leverage is just coming out of the system. It's like oxygen being sucked out of a room. And so there are a lot of things going on. And so that's how I got sort of sucked into the space. And I don't know that many people that focus on this. I don't think many. Because there's a lot of novel legal questions that have to be answered when you do any sort of restructurings or distress when it comes to crypto.
Yeah. I mean, I was saying this before we started recording. I don't think I know anyone that's doing what you're doing whatsoever, which makes this a lot more interesting. But I think you have a really unique vantage point to talk about a lot of this stuff. Obviously, we're involved back with Mt. Gox, and like you've seen all of this sort of unfold since. So having that context is really valuable. I want to have a bit of like a story time, right? Because again, most people won't approach these subjects because they think it's off-putting to new people that are hesitant about the space, wanting to get started. For me, I think, kind of won't get on my soapbox here, but how do you not approach these things? These are the difficult questions that you need to answer when people are thinking about how to even think about the risks associated with the space if they want to get involved.
Well, it's interesting you say that because I'll hear stuff from time to time and I'm just like, who told you that? Like, that is so wrong. I'm like, that's actual FUD. Like I was telling you a story of how somebody was remarking because crypto had, I'm saying crypto, but I know I'm really talking about Bitcoin, but you say the top 10 sort of in general, the whole market was like going like this, last year, when we got $50,000-$60,000 Bitcoin. And when it came sort of crashing down and TerraLuna happened, I was at dinner with someone and sorry, my dog's here. They were telling me how could you invest in crypto? Like the blockchain got hacked. Like that's what happened. And that's why TerraLuna was like a whole mess because they hacked the blockchain so they can hack any blockchain. And I was like, sorry, what? Like who told you that? And so I think when you make something taboo, it's sort of then real FUD gets in because it's just like we just need to talk through these things and talk about what's real and what's not. Is counterparty risk when you're working with on and off ramps into crypto real? 100%. So you need to think about it and how to manage it. Like that's why there are things like people that offer custody that have a very high level of security and, things like Casa. I just met the guys at Casa. They do like a self custody, but it has like 5 points of failure and they have a backup key. Like this is stuff that needs to be talked about. There are probably some interesting businesses to build in this space. But if you're a traditional investor coming into the space and this, so I'm like preaching to the choir here, but you have to talk about counterparty risk and understand it. It's something I assume that like back in the day in the 1900s, people talked about counterparty risk when they were doing securities transactions. Now we've kind of ironed that all out. And, probably not, even sooner than that, counterparty risk. And now with derivative guys that work in derivatives, they know about counterparty risk, and it's time for, and it's not that but it's always a time to think about. But in crypto, these are things that still need to be very ironed out. There's no national exchanges with like pools to make people whole if brokers go down and things like that. And there's no like SIPA insurance and FDIC insurance. So this is all stuff that like needs to be talked about and thought through as an investor. That's why the opportunity exists, but it has to be talked about. It can't just be swept under the rug and considered FUD whenever you bring it up.
Exactly. Like these are real things that need to be considered. And the biggest headlines that you hear about are just prime examples of why you need to be focusing on these things when you're doing your research and getting involved. So maybe let's start there. I guess this is more for people just getting started. And I think most people coming from traditional finance understand the idea of counterparty risk in general, right? At least I'd hope so. But let's talk about counterparty risk within crypto and the details that need to be ironed out there for those who are kind of trying to wrap their head around it.
I don't know what your thoughts are. I'll just give mine. So, and I'd love to get yours actually, because, these CeFi platforms, like their balance sheets can be opaque and you don't have FDIC insurance. You don't have SIPA insurance for brokers and stuff like that. And in the UK and other places, they have other kind of insurance and sort of like ways of dealing with, brokers and things like that, like being adequately capitalized and, being reviewed by either some sort of supervisor's regulatory regime in that system. And crypto doesn't really have that. So I'm sure that that'll be changing in the future, frankly. And I think there'll be regulation around that. And I think that's probably a good thing. So something to think about. So whenever you're buying, like who's your custody? Is it being custodied with a firm? What do you know about the balance sheet of that firm? Getting sucked. I think the biggest thing in Voyager and Celsius is guys really getting sucked into yield products, chasing yield. They're like, hey, it'd be great to own ETH, but it'd be great to own Ether, but it'd also be great to own Ether and get 6%. So like a lot of people got sucked into these trades. And, this is like as old as history, as old as like finance, people probably getting sucked into trades where they can make a little bit of income, like the swan song or this, whatever, the siren song, of, not free money, but just kind of easy money. And so those are things you have to watch out for with whatever provider you're working for. I mean, I think if you do a decent amount of research, you can get extremely credible counterparty with. And I think, my big gripe sometimes with traditional finance people, Caitlin, is I'll hear people that are just like, oh, it's also risky. I can't touch that. It's for somebody else to do. And I'm like, it's with just a little bit of due diligence, full due diligence, but with, some time spent on this, you can easily work around the system and manage exposure. just like anything, if you were giving money to managers or something as an investment strategy, like you would do due diligence on them, and then even counterparty risk about how they custody your assets and things like that. And then you wouldn't put all your money with one, because the only free lunch in investing is diversification, right? And that's true with counterparty risk. A lot of times you're dealing with counterparty risk by diversifying your counterparties. It's not, you can't get rid of the fact that if you have a supplier who gives you a good and it's very critical to what you do, well, maybe you should be diversifying your supply chain just for good measure. So same thing in crypto, and if you're thinking of either TradFi or even people that are full into crypto, that's something they need to not only worry about, but just constantly think about, because the ecosystem is evolving and it's still very nascent.
Yeah. So, I mean, so many points there, right? I do think that oftentimes the risk component of it is used as a cop out for people who want to push off adopting the space, learning about it because it seems overwhelming, or they, think that it's a Ponzi or whatever the comment of the week is. It seems like it's always changing. But what's your process for assessing potential new investments? Like, what does the due diligence process look like for you in a space where there are thousands of opportunities, people building constantly, headlines flying everywhere? How do you stay focused and what do you look for?
So I do it I come at it a different way, which is, I know a ton of people in the venture capital. This is not investment advice. This is, opinions expressed here are solely mine. But I would say that there are a whole plethora of venture capitalist type people that are making venture capital deals. There are people that do venture capital deals and they focus even on a subset, whether it's NFTs or exchanges and like financial services or, just different sectors. So those guys, their cost of capital is much lower than ours, in the sense of they might be writing a check at a $40 million valuation on a company that they know could be a zero, or they know it could be a 50x, and that's their business and that's what they do. And I think as a strategy, if you know what you're doing and you have deal flow, that's probably interesting. We're not quite as connected as those guys, and we don't write checks like that. Usually we're frankly more credit focused. So I like to think that it's unique, our approach, because we can even work in conjunction with those VCs, whether it's venture capitalists or family offices, or even like, the big institutional players like Galaxies and the Genesis and whatever, DCG. Like, these guys have portfolio companies. They might need credit. They have some credit, but they need stretch credit and they can't get involved. Things like that, where we're kind of in an interesting space of being on the credit side, because the crypto credit markets, I know there's DeFi, but when it comes to actually like running the call it the companies that help enable adoption, some of those guys have a tough time getting credit. Traditional banks won't touch them, and especially when you get pullbacks like this, there are only a handful of big firms that sort of, they're not kingmakers, but they can't underwrite everything, and so they can't get involved in the businesses on that. So we differentiated since we're more credit focused, and we try to be helpful to the ecosystem. And I'll tell people straight up, like, hey, this isn't appropriate for us. You should really try to call these 5 people and see if they can help you. And that's the best thing to do. For us, or for myself, you ask my approach, it's, I lead with, let me see if I can add value. And if I can, great. And if you need our capital as part of that, fantastic. Maybe we could talk about something. But if not, that's great, man. Just, remember the little people, and like, call us if you need something, or if you have a friend who needs help with something. So that's kind of, and the due diligence in terms of actually, papering deals, security interest and stuff like that in crypto are kind of a nascent thing. They have like Caitlin, you're familiar with like the Uniform Commercial Code updates that are like pushing through. That stuff's great. It needs to be adopted in all the 50 states. I think like Digital Chamber of Commerce and people like that have been pushing the adoption of the UCC. Like, people think, oh, we don't want, like, why crypto? Why are we talking about this? Because when you go to court as a crypto asset owner, you're gonna want to have good protections, and to be widely adopted, like, we have to. There's something wrong with starting outside the system and then working our way in. But to be mainstream, like, these things are important, and they're important for asset owners of crypto. But in terms of papering, I mean, you paper it just like you would paper any kind of financial transaction. I mean, when we do stuff, I think the only thing I would say is, when it comes to custody, you have to really have strong protocols in place, and you can work with, legitimate high-end firms who help you secure your crypto for doing a transaction, things like that. And I don't want to name companies because Caitlin, you probably know these firms, but they're legitimate providers that can help you with the quote unquote touching the crypto part of any transaction you're working on. And I think that's kind of what you're getting at. I mean, we just use the top tier firms that everybody can use.
Yeah, I mean, the options are there, right? It's more of just knowing where to go. But I do want to get into the sort of storytelling part of this, just because I think you can add a lot of value around context of what happened with some of these scenarios that have gone wrong, a lot of the headlines that we've seen. And we'll start at the beginning, or at least for your beginnings in crypto with Mt. Gox. I was 14 at the time. So when dinosaurs roamed the earth back in 2012, it's probably one of the biggest. Yeah. Just a little one at the time. But that's probably one of the biggest headlines that when I've spoken with traditional financial participants about crypto, that's one of the biggest situations that they point to. Oh, well, Mt. Gox. It's just one of the biggest stories out there in the space that is constantly brought up, but I'm not really confident that a lot of people actually know what happened. So enlighten us, what was the situation? How did it get to where it was? And what was sort of the outcomes from it? Did anything change after all of this went down?
Yeah, Mt. Gox is unfortunate. Nothing really happened like in terms of protections for crypto asset owners post Mt. Gox. Although Mt. Gox isn't totally over, so I guess you could say it's a little bit in the back of people's mind. So Mt. Gox was interesting. I guess it was such a shock to the system because it was like 70 or 80% of the volume of traded Bitcoin. It probably was less because my local Bitcoin, I don't think anyone was probably keeping good statistics on it. But you know what, my local Bitcoin, or you're too young for that, where people like would go to coffee shops and like buy Bitcoin. And like, you're like, I don't know how they even did it. It was like a total trust. It's like real trust. I mean, they're like, okay, send it to my wallet. I'm going to hold your arm while you send it and I'll give you the CAD. I don't know how people did it. I guess you could have used like an escrow service for a law firm. I'm sure so back in the day, some lawyers did that. But so it was a big when it happened. And also, there were a lot of missing Bitcoin. I mean, the issue with Voyager and Celsius now is they blew holes in their balance sheet by not managing the risk of their loan portfolios well enough. Okay, that's a little different than, just waking up and they're like, oh, by the way, like 3/4 of the Bitcoin isn't here, or actually in Mt. Gox's case, it was, something like 3/4. They found 200,000 in a cold wallet.
So that's what I was going to ask, Tom. So then, what was the most basic sense of it? What actually happened? You heard a lot of people that, completely lost their Bitcoin from this situation. Maybe they got it back eventually. Maybe they're still working on it. Like you said, not everything's done, right. But like logistically speaking, what happened? What happened that led to that? Yeah,
logistically. Yeah, what happened? That's a good question. There's a journalist who's working on like this big like investigative journalist piece on this. And, it's fun to sort of speculate about. I think basically what happened is Bitcoin was not a thing, right? It was just like backwater. Mt. Gox technically stands for like Magic the Gathering trading cards or something. And so it was people trading kind of collectibles. And then from there, they started trading Bitcoin, or maybe they were making payments in Bitcoin. They started trading Bitcoin. And then Bitcoin was still kind of a thing, but not like a huge thing. And so they didn't have security protocols. They didn't understand that like they were a honeypot that could be attacked. And, there was known that there was missing Bitcoin, but they thought that, hey, if we just make enough money trading on the volume, we can replace the Bitcoin. But then as Bitcoin went up, they were like, oh, wow, this hole is getting bigger because Bitcoin is going up and we owe this amount of Bitcoin. So I think it was just like guys that never expected it to blow up the way it did, and in terms of interest in crypto, in Bitcoin, and they were just sort of unsuitable for like running this. There was no thought, there was no capital to be able to set up security protocols, and so there was always like basically hackers that had access, and they were sort of leaking out funds, and they could never really find out how they were stealing the funds. people say it was an inside job. I doubt it. I think that it was um, likely that there was just always a security hack, and they just sat on it and tried to figure out how to fix it. Meanwhile, I kept running the business. So that's what happened. And so there was supposed to be 850,000 Bitcoin, which is a ton of Bitcoin, right? But when they actually filed for administration, they didn't have any. They had like a few thousand Bitcoin, and then they found 200,000 Bitcoin like in a cold storage wallet. So they basically had like 25% of the Bitcoin they said they had. And then, the Japanese filed for administration in Japan, and it's taken a really, really long time because it's crypto and it's Japan. And the big argument was who gets the uplift in value. So in 2018, Bitcoin, I believe, is it like a few $1,000s? No, is it like basically like 5 to 10 grand? And so if you do the math, they only have 25% of the crypto. But remember, crypto is now like 10x from when it went bankrupt. When it went bankrupt, crypto was at like $400. I'm using Bitcoin here. I don't mean this to like interchangeable and sort of conflate them. But Bitcoin is at 400 now. It's at 4,000. So now you're 10x up, and you have 25%. So if you only have 25%, but you make a 10x on that 25%, that's over 100% repay of your original 400. So technically, you're kind of in the money in the fiat sense, not in the crypto sense, but in the fiat sense. And so then there became a big argument in 2018, who should get the uplift? Should it go to the claimants, or should it go back to the equity holders? Well, the equity holder was in jail at the time. He had been tried, not necessarily for stealing the Bitcoin, but I think he got tried for like cyber crimes, which is because he basically set up a bot called the Willy bot to basically trade against customer accounts to try to make back Bitcoin to fill the hole. I know, crazy. Can't make it up. They're gonna make a movie about it one day. And yeah, and then the recovery is basically the same. They sold a bit of crypto, so the recovery is like 20 cents on the dollar, but of course 20 cents on the crypto dollar, and crypto now is at 20 grand. Let's just 20 grand. So that's a huge move. So everybody that stayed in still made like a 10x or 15x or something.
Man, I feel like there's a lot to that story too, and it's still going, right? So where are we at
Force
with that
total.
now in terms of like getting all of that buttoned up? I feel like it's just a slow crawl.
Yeah. So
2012.
Yeah, no joke, right? I know, right? Crazy. 2014 is when they filed. So yeah, they're supposed to. I mean, the plan was confirmed, and they should pay out soon. But what does soon mean? I think that they're going to start doing. This is what I hear from sources: is that the early payouts will be in like January, February of next year. And then the final payouts, which is where we are, because the early payouts were for people that either have small claims or wanted an early payout, but you give up some of your recovery if you take an early payout. If you do final payouts, it's probably the end of next year, not this year, but next year, or even going into 2024. So it's going to take a while. Also, like, people shouldn't, there's FUD around like the distribution of the crypto here. I'd love to like break it down some way. Like, this would be like a totally different podcast, but there's 200,000 Bitcoin that are coming on the market, or not really, about 141,000 Bitcoin. But of that 141, there are a number of big blocks of that are not going to come online. One of them is Bitcoinico. One of them is like Fortress that bought a bunch of claims. There are big blocks of that 141 that will not come online when there's a distribution. And most of the guys, they're going to be sitting on such a low tax basis that what it's really going to affect probably is the lending market for Bitcoin. It's just going to bring down that like yield you can earn, because there's going to be a lot of new crypto, and the guys are going to want to sell and get taxes. They're going to want to reapothecate, or whatever the phrase would be, and earn interest on it without generating the tax. That's what they're going to want to do.
Yeah, I trying to think of even like what to say to that, and I can't, just because it's a lot going on. But transitioning to just too much to unpack there. It could be another episode, I think, and maybe it will be. But transitioning to today. So you said 2014 with filing and everything. It's 2022, still going on. But in addition to that, it's not just been Mt. Gox. We've seen Celsius, Voyager, TerraLuna. How were those situations, the headlines that we've seen in the past year, past 2 years, how are those situations different, and where did things go wrong as opposed to what we saw with Mt. Gox?
Yeah, Mt. Gox, it was so early. There was no laws, no rules, no nothing. I mean, it was really kind of a slap together company because of the fact that they didn't know that crypto was going to become a thing. And now, of course, now fast forward, crypto is kind of mainstreamish. And so for Celsius and Voyager, it's a little different. There are a lot of, I don't want to call them mom and pop investors, but a lot of just individual investors that were trying to get interested in crypto. They like the yields. People were like, oh, look at this yield. I don't earn anything in my interest rate and my regular savings account. Boy, if I could make 8%, that'd be amazing. 10%, that'd be amazing. So they got sort of sucked into that. So there are a lot of people that are just, I want to call them normal people that are not necessarily running portfolios. They don't even own stocks. They basically own index funds, and then they have crypto, which is kind of like, anyway. And I think it's I guess a little disheartening that some of them got sucked into this, and this is like their first foray into crypto. So there's a lot more like people with life savings, people with college funds, stuff you hear, like people that their business they were using as their banking account or for a savings account for their business and for their employees' bonuses and stuff that you're just like, oh my God. So it's gotten more mainstream, and it's unfortunate that it's so that's different. Also, what's different is these are U.S. bankruptcy processes, or Chapter 11s in the States. So the process will be a lot faster, a lot more transparent, and we'll probably get a lot more case law that will be useful not only for insolvencies but also for general crypto litigations and legal fights. And what else? And I think there'll be a lot more eyeballs on what happens and what kind of regulations we need to put these CeFi institutions through. I mean, was Mt. Gox a CeFi institution? I don't know. Yeah, I guess it was, because you were buying it and holding the crypto there. But these are like legit CeFi. I mean, guys have like 15 different. I got to close the door because someone's decided to mow their own. But they've got like 15, 25 different cryptos in their account, and that's cool. But there isn't really a lot of regulation around what these things are, how they should be regulated, what kind of products they should be able to offer to their customers in different states, different countries. So I think there's gonna be a lot more regulation that come out of these, because the processes are very in the press. First, Mt. Gox was going on in Japan, and crypto was this weird magic internet money that no one knew what it was, and it was something either computer geeks or like money launderers were into. It was sort of dismissed as like, hold on, I'm gonna close this while we talk. It was sort of dismissed as like not a thing, that anybody legitimate would be into. And there's some of that FUD that still goes on, but anyway, does that answer your question? So I think there'll be a lot more regulation, a lot more eyeballs in this.
Yeah, and you made a lot of good points there too. I think one is the media and how that's even changed in the last 5 to 7 years, right? Like headlines are constant. Crypto is always in the headlines. It's just like literally is one of the only constants that we see, is that there's always something in the headlines having to do with crypto. And these are certainly things that would make the news. That news takes off. It gets circulated everywhere. It's everything that people are talking about, just nonstop. Also, though, right, with crypto becoming more mainstream, the people that you're seeing be impacted, it is a lot more of the mom and pop types that are just getting started. They see the yield that's attractive. The numbers are really, really high versus what you see in traditional markets in a lot of situations. And I think that has a tendency to suck people in without doing proper due diligence, which maybe if we want to peel back kind of the onion a little bit more on what happened with Celsius and Voyager, because to your point,
sure,
that's going to be in the headlines quite a bit. I think there's a lot to unpack on that.
So I should say there's a whole continuum of people when it comes to their views on this, and I'll try to keep mine as like moderate as possible. Like, I don't want to say, there are people that say, oh, these are Ponzi schemes and they were doing stuff they shouldn't have done and they stole our money. That's like one camp, and then the other camp is like, this is a bank run, and this is because of fudsters trying to kill these companies and for their own profit or own benefit. And like, you can take facts and kind of meld a story any way you want. But basically, these were kind of early banking institutions within crypto that didn't have a lot of regulation. They were trying to grow. They were trying to grow because they themselves wanted to enrich themselves, owning a big company, but also because they probably believed in crypto adoption. But financial firms getting over their skis by blowing up on a loan book is a story as old as time. There are millions of, throughout financial history, Solomon Brothers. I mean, that was like more regulatory, but, guys in the financial crisis, RTC, like Resolution Trust Corporation and banks, savings and loans, getting over their skis on loans in the 80s. So this is something that is not new. But basically, these guys, you sign up, you get you get an account. It's on your app. You can add, whatever fiat. I'm pretty sure you can add fiat, but I think for Voyager you couldn't add. No, for Voyager, I think you could add fiat and then buy crypto. I think with Celsius, you had to sort of buy some stable coin and then go on to their app, I think. And from there, you could move it around, get yield from their yield product. And people were using it as a savings account. Some people had debit cards, I think, in some jurisdictions, so they're using it like a bank account. And so think about it just like your Chase account on your phone, right? You've got Chase, you have a debit card, you swipe your phone, you tap your phone to pay for things. It was just like that, but instead of using your dollars, you were using stable coins, and you were able to move it around quickly and also make higher yields. So that's how people got sucked in. And I think these are great potential products, and I don't have a problem with it. It's unfortunate that there probably weren't a bit more rules for the road. I mean, to push back from the other perspective, it's not like the regulators were on top of any of this stuff. I mean, the regulators basically send out like cryptic messages around what they're going to regulate and how they're going to regulate it. And, I think if you're trying to grow at all costs and the regulator's not saying no, well, then people have a tendency, to go to the lowest common denominator of like what they'll push for. So that's the problem with some of these institutions. And look, if you were using these products and then periodically taking stuff off to keep in what would, in crypto world, cold storage, or just to diversify. So you had Coinbase and you have Kraken and you have Voyager and Celsius, and you use 5 different platforms, and then 2 of the 5 go under because of the issues. Like, that's not ideal, but it's clearly a little better strategy than having, one CFI. And also, like, I mean, I don't know what your thoughts on this. For me, I think if you have a crypto portfolio within your general portfolio, you should probably have like some decent percentage that's just totally offline, in like a self-custody type approach. And then you should have a decent percentage that's online, right? That you're using, whether it's you're using your Coinbase or you're using your FTX account, whatever jurisdiction you can open an account and live in. And of course, there's more noise here. Sorry. And oh, never mind. And I don't know. I mean, what are your thoughts on like mitigating? I feel like it's just like you buy a stock portfolio. You want diversification. You want to be thinking of the risk of underlying, and it's judgment. And
Yeah. I mean, it's still early days, right? Everyone always says it's so early, but to your point, diversifying like not only the assets that you own or the projects and protocols that you're involved with, it's not just that. It's also, where are you storing your assets? Are you putting all of your eggs in one basket? Are they in cold storage? Are you using a software wallet? Are you using a centralized entity? And there are risks associated with all of those things, and they're unique to the solution. So the more that you kind of disperse that risk and spread it out, to your point, like you're better off that way. It's like investing too. You don't want to put all of your eggs in one basket ever, because even if you have the utmost confidence in wherever your assets are being stored, or, the project that you're investing in, there's just way too much risk in only using one solution or one investment. And even if your conviction's high, that doesn't mean that you should go all in, which I think people tend to forget when we're seeing incredibly attractive yields, or we're seeing opportunities that seem like a home run or easy money. And it's very simple to get caught up in. And we've seen people do that time and time again.
Well, I always love the Michael Mauboussin, like, it's not a quote, but like a study that was done, and he's great at like kind of synthesizing a lot of that behavioral finance stuff. And he says, like, the more time you spend in something, the higher your confidence gets, but actually your predictability isn't increasing. So it's like predictability is kind of like going like this in the first, and then it sort of flattens out. And then, but like your confidence is like this, like all the way up, So it's like, so even if you're like super bullish on crypto as an asset class, whether it's you're a Bitcoin maxi, or you just like the main projects and protocols, or you're just like really into, gaming or NFTs, you still have to think about like, okay, like how am I accessing this? Like, will I be right but wrong because I got tripped up on counterparty risk? And what am I doing? Not necessarily to 100% insulate myself, but just in a like draconian situation, like in the market, like are some of these firms I'm connecting with, am I at least diversified and have a good idea about what might be riskier than others? So just like you would with
yeah.
So
yeah, I mean, the counterparty especially, right? And the storage part is just so critical. So I'm glad that you mentioned that. And, you know, it's not a trivial decision to make. And it's something that people should think about a lot more than they do. Even with, you know, more centralized solutions, which are familiar to people that are just getting started. It looks like a regular sort of brokerage account. Right. It seems familiar. It seems very trustworthy, but always do your due diligence. That's like, I can't emphasize that enough. But also when I talk about that on the investment side too, right? Just because I think of TerraLuna, and maybe that's sort of the last one we cover because that brings us more to like today in terms of due diligence, not only around, you know, the counterparties that you're working with or like where you're putting your money, but also the technology and how it actually works. So a Bitcoin versus a stable coin versus an algorithmic stable coin, and taking the time to do the research on what could go wrong there, because we very clearly saw that play out with TerraLuna more recently.
You know, the funny thing about TerraLuna, I had so many people ask me about TerraLuna. I was like, I don't really understand the stuff like well enough. Because I was like listening and like I think I read some of the white paper and then I was kind of like following the summaries of what it was, and I was like, okay. I mean, I don't totally understand how this works, and boy, am I glad I didn't tell anybody. Like, yeah, this is great. It's better than sliced bread. Because you would have people who were like, it's just they view like price as a signal, and Mike Yusko, who I'm agnostic on Mark Yusko, but he does say that like price is a liar, which I think is always a great thing to remember. Like, you can't just use price as an indicator of whether something's a good idea or not, because that'll come back around. I mean, I can't remember. It wasn't Luna, but it must have been Terra that was like to the moon and then just total burnout. And it didn't totally make a lot of sense to me doing me. That doesn't mean I like knew that it was going to blow up. It's just, you know, you can miss stuff. I just think if you spend enough time understanding the philosophy, and then maybe you have someone helping you with the technical stuff, or your manager you like, or a few managers, and then from the other side, from a counterparty risk, like that's not so hard for you to underwrite if you just general finance accounting background, like just thinking about like, okay, well, I want to split this into 4 accounts, or I want to split this into 2 accounts or 5 accounts, and I want to have some offline and some online. Very similar to you think of just like managing a portfolio. You don't need to be like a technical expert, and I don't think you're going to be able to get there on a lot of crypto projects. I mean, honestly, even for myself, like I read some of the white papers of what some of the structures people are doing. I'm like, like, okay, like I have to trust you and kind of go by like the idea, the analogy of what you're explaining, because I don't really understand how this new consensus mechanism you want to use for this new stablecoin how it works. So some of it will be beyond ability to totally due diligence. But if you're doing it, like if you're like, okay, I like the idea, I get it, I like the team. Okay, I put some small percentage in, right? Like sometimes you can control risk just by position sizing, and that's probably more important than like, I'm now a PhD in like elliptic curve geometry, and I can explain exactly how this this thing will be technically beneficial, you know, because that's hard. Can't be an expert in everything.
You can't. And I also think that the term crypto expert is an oxymoron at this point, just because so much is being built and it's growing so quickly that there's no way to possibly have deep subject matter expertise on it all. But like even with traditional investments, I might not be an emerging markets expert or an expert in commodities, but if you're trying to think of how to diversify, right, to your point, position sizing is an easy way to control that as well, with just the simple idea of not putting all of your eggs in one basket. It always goes back to that
simple risk management.
Yeah.
Simple risk management strategies. You know, what is it like? I don't know. There's like Cliff Asness, so I quote this guy all the time, but he's a famous quant, and he likes to say like, we all know what we're supposed to do to like lose weight. It's sort of like eat less, move more. And his view on investing is like, we all kind of know what to do. We try to make it more complicated, which is like, what does he say? He says like, try to, he's something like spend less and diversify more, meaning like try to watch out for fees. He's talking about general finance, like watch out for fees. And basically you should always kind of probably be more diversified than you are. This is like the only two like obvious things. And yet people sort of forget them. One thing I noticed in crypto, sometimes I don't like is I once had a friend, I'll give an anecdote, but it's a general idea. He didn't want the responsibility of figuring it out. So he gave it to a guy and he asked me about this guy. This is a little while ago. And he's just a friend. And I was like, hey, dude, like, I don't know who this person is. Like, he doesn't, what he's saying doesn't seem to add up, just in my general view. He was sort of promising some ridiculous, like, oh, I can do crypto, but I can do it a supercharged. I can make like 300%. And I was like, yeah, I'd just be very careful of, you know, kind of like, I'm going to get you rich quick, you know, sort of schemes. And my friend really fell for it and sent the guy money. And the guy ended up being a fraudster and just like ran off with his money. And it was sad because I had just told him, like, I looked at the old email. I didn't have the heart to send it to my friend, but it just says like, dude, you should just go on, if you want to get into this, like go on to Coinbase and buy it yourself. Like you don't need me, you don't need anybody. That's the whole point. And so try to get into it philosophically. And then once you figure that out, like baby steps in, you know, is my always thoughts for people. It's just like baby steps into stuff. And then maybe you decide it's not for you, or maybe you said like, wow, this is actually really cool. There's so much innovation going on. I want to be part of it even more, but just start slower. I know it's, you know,
everyone wants the get rich quick kind of scene, but doesn't want to put in the work to get rich quick or to get rich. Maybe not quickly, but definitely takes a lot of work, and also like the self-control and the, you know, not going too in on any one idea and getting in over your skis. And there's a lot of it. And there could be a whole discussion around like the behavioral side of it, because that's everything. And we've seen people get caught up in that time and time again.
Can I say one point on this? Let me say one more point on this is, people that are into like not cryptography, but they talk about like technical hacks and stuff like that, and how you're going to get. And I remember it was maybe an FBI agent or someone was saying this somewhere on like a YouTube video. They're like, people think they're going to get hacked all the time. It's like, no. They don't hack your computer. They like hack your mind. Like most of the thefts and then sort of things are done via just like social proof and stuff like that. Like, oh, you went to this school, you know, John, I know John. Oh, you know, it's so funny. And then all of a sudden you've sent someone $10,000 for some investment that's bogus or something. Like you're much more, and even with the way the CFI guys position themselves, like that was one of the really kind of, I think, aggressive things that was done in Celsius is the guy really got you revved up about not being part of the banking system and how you got to unbank yourself, or you got to, you know, banks are evil. And that rhetoric kind of fires up the base of people that want more and better institutions than we have now. And I am too. The problem is then he makes a logical leap and says, so send me your money, you know? And that's the part where you got to be a little bit like, oh, okay, I totally believe the premise, but now there's this logical leap that this is the way I'm going to capitalize on it. And that's the thing you got to be careful. And it's like, there's a Seth Klarman quote here. Caitlin, you're way too young to know who you know Seth Klarman. I'm sure maybe Robert, you know, I'm sure Bobby has been telling you all about him. But let's see. But he says the thing about doing macro is you have like 3 layers of potential mistakes. You have the first layer is a theme that works. Then you have to take that theme, and so you have to figure out how the world works. Then you take that and you make a theme, and then you take the theme and then you find individual companies to invest in. And his point is like at each point in that chain, you can make a mistake. And if you make a mistake on either one of them, the investment won't work. And so his view is you have to be very careful of these thematic and like macro calls, because you have to be right about how the world turns out. Then, and in your theme, you have to be right about the way the theme works. And then you got to kind of figure out, you got the companies that actually benefit. The same thing is true somewhat in crypto. Like, let's say crypto is the future, and our new financial system will be more stateless, more sovereignty for the individual, and there'll be this beautiful Web 3.0 ecosystem as opposed to a bunch of monopolies, which is what we have now. So now I've just stated like a theme or premise, but then to capture it, you have to find the individual protocols that you like. And then there's another layer, I guess, in crypto, which is counterparties. You have to make sure that you don't lose out on the benefit of being right about, I'm making it up, you're into ADA, you're into Chainlink or something, or you're into, the new merge, so you're really into Ethereum. You have to be careful that if you buy into the premise and you go buy it, that you actually get that return, and it doesn't get on a CeFi institution where you have issues or you haven't really properly thought through the security of your crypto. I'll be quiet.
No, I love that. Rant away. But I do want to wrap up because I think we could talk about many things for a lot longer than this. Not sure. Maybe we'll have you back to do that, because why not? But I always ask the same questions towards the end, and there are kind of more big picture questions here, point about just talking about macro, but sure. If crypto is the future, I'm thinking best case, sort of quote unquote, worst case here. If crypto is the future, what is the primary reason for its success? And on the flip side, if we see crypto utterly blow up, utterly fail, not ever reach the potential that a lot of the people in the space think that it should, what would the primary reason for that be?
Regulation. So, and I say regulation meaning that the people in the ecosystem are such bad actors that the governments around the world are saying, no, like, we're not allowing this. And I think the threat of, I wouldn't say threat, but they say, hey, maybe we should digitize currencies. But we don't like the idea of non-state, non-sovereign crypto. That's the biggest risk in my mind. And there's probabilities weighted to all this. The best person to listen to if you ever want to think about like crypto, in my mind, I wish it would be more public. He's sort of gone into, I don't know where, but he's a guy named Wences Caceres, and he's amazing. When you hear him talk about crypto, I mean, what was the first part of the question? What will make it successful?
Yep.
I mean, I think it's inexorable. I think the genie is out of the bottle. I am like, the genie's out of the bottle. You're not putting it back. And whoever Satoshi Nakamoto was, God bless him. It's such a great idea. Such a powerful idea of separating government and money. Just you separated church and state. I mean, that's super powerful idea. And, ideas are, I guess, the most valuable thing in the world. This was amazing. And the way it was structured. So I wouldn't say I'm a maxi, but I do believe that Bitcoin is here and there's no putting it back. And I think there is a probability that gets so regulated because this is why I'm so vocal now, I guess, in the industry is we need to be our own, we don't want to be our own worst enemy by having people in centralized authority, right? Like governments and presidents and things like that saying like, actually this Bitcoin thing or this crypto thing is really bad. We got to regulate this to its death. And I think that's a probability that's in the cards. And I think the threat of regulation is probably the biggest thing. It also could, I guess. Yeah. So to me, that's the biggest risk. And I don't know. It's not like it can be answered, but I do think if you're in the crypto ecosystem or even considering it, try reading up on the philosophy of just like why we'd want these things. I think it's good. I think it's good. I think Web3, I love all the Web 3.0 projects. Some of them will be successful, and I assume a number of them won't. But I think it could be really great for the future of humanity. But the risk are regulatory, and it's not a sure thing that governments are going to go down, like in terms of like letting go of the power of money supply. That's quite a big ask if you're a superpower, and so we'll see. And now, I mean, the last since I'm not, of course, I think that sanctions against Russia and the Ukrainian war, just to get really topical. I understand where the U.S. government's coming from, trying to impose sanctions, and in the EU and stuff like that. But I mean, weaponizing the money supply is kind of like a pretty aggressive thing to be doing. And, I think crypto kind of does solve some of the stuff because it sort of like makes it more neutral. And it's like money is kind of a neutral thing. I don't know that the governments around the world should be, in my, I guess some people would probably say hyperbolic language, sort of weaponizing it for purposes of their own agenda. I mean, they wouldn't say that. They would say, "Oh, we're good." It's like, "Oh, okay. Well, it's fine if you're the good guy." Okay, it's okay. It's going to be a fascist because you're right. It's like, so it's a little. I don't know. I'm really getting way off of or over my pay grade. But if you want to ask me, that's my answer, which is regulation risk.
No, I wanted your answer for sure. It was perfect. Well, thank you so much for being on, Tom. I really appreciate it. Kind of excited to see how all of this unfolds and see if your projections are right here. I feel like you're kind of right on the mark, but wouldn't have had you on, I guess. Thank you so much again. Thank you to everyone for listening as well. We will be back next week with another episode. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of the hosts or any of their affiliates. This podcast is for commercial and informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities or cryptocurrencies, nor is this an offer or sale of a security or cryptocurrency.